In today's world, it feels like we're just constantly navigating this flood of information. Data is everywhere. How do you even start to cut through the noise, find the really important stuff, and make sense of it all without just, getting overwhelmed?
Yeah, it's a huge challenge. I mean, the sheer volume, the complexity, it's really unlike anything we've seen before.
And that's exactly why we're doing this deep dive today. You share this fascinating stack of sources. We've got some foundational texts on statistical learning and machine learning, plus this really interesting research paper looking at how these powerful techniques get used in finance, specifically for things like predicting stock performance.
Exactly. These documents, they give a pretty comprehensive view, actually. They take us from the core ideas, learning from data, all the way to practical applications. And they also cover the underlying math and stats that make it all work.
Right, so our goal for you, the listener, in this deep dive is really to be your guides through this material. We're going to try and unpack the essential concepts, show you how they work with concrete examples from the sources, and explain why they're becoming, well, indispensable tools, across so many fields, but especially finance, it seems.
Think of it as a shortcut, maybe, a fast track to understanding some pretty powerful ways we have to analyze data today.
Okay, so let's jump right in then. The sources introduce statistical learning as this broad collection of tools for understanding data. What's the sort of fundamental split they make right at the start?
Well, they primarily divide the field into two main camps, you could say. First up, there's supervised learning. This is the type where you have a specific outcome, an output variable that you're trying to predict or estimate. You've got examples where you already know the correct output for given inputs. It's almost like having a teacher, who can tell your model if it's right or wrong.
Okay, so you're building a model to map inputs to an output you already know the answer for, basically.
Precisely. And then the other main type is unsupervised learning. Now, in this case, there's no specific output variable you're trying to predict ahead of time. Instead, your goal is more exploratory. You're looking for interesting structures, relationships, maybe patterns within the input data itself.
So it's like exploring a new data set without a specific question, just see what jumps out.
Yeah, exactly. Just looking for what stands out, what connections are there.
Let's ground this a bit. The sources use some examples, right? They talk about the wage data set.
Yes, that's a classic supervised learning example. The problem there is predicting a person's wage. And you do that based on characteristics like their age, their education level, maybe the year the data was collected. The sources actually show a plot, wage
Hmm.
against age, and you can visually see this clear, nonlinear trend. Wages tend to rise with age.
But then they dry off later in life.
Right. They seem to decrease after around age 60, according to that plot.
But looking at that plot, I mean, there's also a lot of spread around that average line. It's not like everyone of the same age earns the same.
Exactly. That's a key point. Predicting a specific person's wage just based on their age, it'd be pretty inaccurate. There's just too much variation driven by other things. The sources really emphasize how important factors like education level are. People with less education, on average, earn significantly less.
So the real power comes from combining these different inputs, age, education, year.
That's it. You combine them to build a predictive model. And this is where methods like linear regression come in. But also, you need more flexible, nonlinear approaches to capture that curve you saw in the age trend.
Okay. What about the stock market example the sources mentioned? That feels very relevant for listeners interested in finance.
Yeah, that's another supervised learning scenario, but it's a
Right.
bit different. Here, the goal is to predict the direction of the daily movement of the S&P 500 index. Is it going to go up or is it going to go down?
Okay.
The inputs might be things like the index's movements from the previous days, but unlike the wage example where the output was a number, wage, here the output is a category up or down.
Ah, so it's a classification problem? Is that what the sources call it?
Exactly, classification.
And I found that detail about the box plots really interesting, showing yesterday's movement versus today's direction.
Yeah, what's fascinating there is how it looks at first glance. If you just look at the distribution of yesterday's returns based on whether the market went up or down today, they look almost identical.
Which seems counterintuitive, maybe.
Well, it might seem surprising, but think about efficient markets. Any really simple, obvious historical pattern tends to get exploited and, well, disappear pretty quickly.
Right.
However, the sources do note that while those simple linear relationships look weak, when they applied more complex statistical learning methods to that same data over a specific 5-year period, they were actually able to predict the market's direction with about 60% accuracy.
60%. So better than just flipping a coin.
Exactly. Now, 60% accuracy doesn't guarantee you'll make money, obviously, but it is better than random chance, which is 50%. It highlights that subtle patterns can exist, even if they aren't jumping out at you from simple charts.
And this difference between predicting a number, like wage regression, and predicting a category, like up-down classification, that's important.
It's fundamental. It leads you to use different kinds of methods. For classification, you might use something like logistic regression or linear discriminant analysis, which the sources mention.
Okay, so we've covered supervised learning, where you have that target output. What about the other kind, unsupervised learning?
Right. A good example from the sources for that is the NCI 60 cancer cell line data. Imagine you have these really detailed measurements. The activity level for thousands of different genes across many different cancer cell lines.
Okay, lots of data.
Tons. But crucially, you don't have a specific outcome variable like survival rate or response to drug A that you're trying to predict right from the start.
So what's the goal then, if you're not predicting something specific?
The goal is to find structure within all that complex gene expression data. You're basically
Right.
asking, are there natural groupings, clusters of these cell lines based purely on their genetic profiles?
And do they find clusters?
They do. The sources show how visually representing this data often reveals that cell lines that came from the same type of cancer, they tend to group together in the data space.
Ah, interesting.
And that's the essence of clustering, which is a key technique in unsupervised learning, finding that inherent structure without having a predefined label to predict.
This whole field of statistical learning, it feels very modern, linked to powerful computers and big data. But where did these ideas actually come from? Do they have a longer history?
Oh, absolutely. Yeah, while the term statistical learning might be more recent, many of the core concepts are, well, surprisingly old. Take the method of least squares, for example. That's the basic technique behind the simplest kind of linear regression predicting a number like salary. That dates all the way back to the early 19th century.
Wow, really? What was it used for back then?
Its first applications were actually in astronomy, fitting curves to observations of planets and stars.
That's incredible, from charting stars to predicting wages or stock moves.
It really shows you how broadly applicable the underlying math is, doesn't it? And then for predicting categories like survival versus death or market up versus down methods like linear discriminant analysis popped up in the 1930s. Logistic regression came along in the 1940s.
Okay.
And these were sort of brought together under one roof, the generalized linear model, in the early 1970s.
Okay, and here's where it gets really interesting for me. The sources explain that for a long, long time, the methods were mostly restricted to finding linear relationships. Why was that?
Yeah, that's a key point. It was primarily because dealing with nonlinear relationships computationally, it was just extremely difficult with the technology they had back then.
So the math was there, but the machines weren't.
Pretty much. But then came the explosion in computing power, really starting in the 1980s, and that changed everything. It suddenly made these nonlinear methods feasible, and that led to the development of techniques like classification and regression trees in the mid-80s. Then you had the rise of neural networks, support vector machines in the 90s.
So computing power was really the key that unlocked all this.
It was a major unlock, yeah. And that kind of brings us to today. Statistical learning is now this well-established field, and it's been fundamentally transformed not just by sheer computing power, but also by the widespread availability of powerful, but also user-friendly software tools, especially in languages like Python, which the sources mention quite a bit.
Right, making it accessible to more people.
Exactly. That shift has dramatically broadened access.
Yeah.
These tools, they're not just for specialists in stats or computer science anymore. They're becoming part of the standard toolkit for researchers, for practitioners across business, healthcare, genetics, social sciences, you name it.
And that's really why this history matters for you, the listener, isn't it?
Absolutely. The sources really emphasize that these contemporary methods, they aren't just academic toys. They are widely applicable, incredibly powerful for tackling real-world problems. The feeling is that techniques like these, they're on track to become as common, as fundamental to data analysis as something like, well, basic linear regression is today.
Okay, let's maybe zoom in on one specific technique the sources discuss, one that feels quite intuitive when you first hear about it. Decision trees.
Yeah, decision trees are great because the basic idea is pretty easy to visualize. Imagine you're trying to predict if, say, your friend will enjoy playing a particular sport on a given day. And you base that prediction on factors like the weather conditions, is the sky sunny, what's the air temp, humidity, wind, stuff like that. Each of those factors is an attribute.
Okay, attributes like sky, temp, humidity.
Right. And a decision tree helps you figure out which combination of these attributes leads to your friend enjoying the sport or not.
So it's like a flowchart of decision.
Exactly like a flowchart. It represents a series of simple decisions based on these attributes. You start at the top, that's the root, and at each step you check the value of an attribute, like, is the sky sunny? Based on the answer, you follow a specific branch down the tree.
And you keep going down.
Yeah, each path from that root all the way down to an endpoint, which is called a leaf, represents a specific set of conditions, like sky is sunny and air temp is warm indeed, you know, and that path leads to a particular prediction, like yes, they enjoy the sport, or no, they don't. The whole tree is basically just a combination of all these different paths.
Okay, that makes sense visually. But how does a computer learn which questions to ask? How does it build the right tree from data?
Good question. The sources talk about algorithms, like one called ID3, which use this kind of greedy top-down approach. So starting at the root, at each step, the algorithm looks at all the attributes it hasn't used yet on that path, and it decides which one is the best one to split the data on next.
Best. How does it measure best?
So the goal is to pick the attribute that does the most effective job of separating the data examples based on the outcome you care about, like whether they enjoyed the sport or not.
Yeah.
The sources explain this is often measured using a concept called information gain, which itself is based on something called entropy. Entropy is basically a measure of how mixed up or impure a set of examples is regarding the outcome.
Impure, mean.
And if all the examples in a group have the same outcome, like everyone enjoyed the sport, the entropy is low. That group is pure. But if it's, say, half enjoyed it and half didn't, the entropy is high. It's very impure or mixed up.
Got it.
So the algorithm greedily picks the attribute that gives you the biggest reduction in entropy when you split the data based on its values. It wants to make the resulting groups of examples as pure as possible regarding the outcome.
Okay, so that's the abstract idea. Pretty neat. How does this connect back to the real world, especially that finance problem we touched on, predicting stock stuff?
Right, that's where the research paper you shared comes in. It's a great practical example. It uses decision trees, specifically, to try and predict the direction of earnings changes for Chinese companies, looking 1 year ahead.
Earnings changes. So whether profits are going up or down.
Exactly. Whether a company's earnings per share, or EPS, is likely to increase or decrease next year. And that's exactly the kind of information investors are hungry for, right? It helps them decide whether to buy or sell a stock.
So the paper is using these data-driven methods like decision trees to try and get an edge in financial forecasting.
Precisely. They frame it as a classification task, predicting if next year's EPS change will be positive, call it +1, or a negative -1. And the paper highlights why these data mining methods, like decision trees, are pretty well suited for this kind of complex problem.
Why is that?
Well, they argue these methods can potentially uncover non-obvious patterns in big financial data sets. They can handle the scale better than some traditional models, and crucially, they don't require making really strict assumptions about how the data is distributed, which, as we'll see later, is often a problem with financial data.
Okay. What kind of data did they actually feed into these trees? What were the inputs?
They used 50 different financial ratios. These are things calculated from companies' published financial statements, first from the balance sheet or income statement. Things like the current ratio, debt-to-equity ratio, net profit margin, that kind of thing. Those 50 ratios were the inputs.
And the output was just +1 or magical 1 for the EPS change.
Yep, the direction of the following year's EPS change. The paper does mention some practical hurdles, though, like dealing with missing data in the financial reports, which is apparently common. That reduced their usable sample size each year.
Did they find that just a basic decision tree worked well enough?
Actually, no. They compared a standard basic decision tree with two sort of enhanced versions, one using boosting and one using bagging.
Boosting and bagging.
Yeah.
What are those quickly?
They're both techniques designed to improve the performance of machine learning models. The sources explain bagging, which stands for bootstrap aggregating, often works by building multiple trees on slightly different versions of the data and then averaging their predictions, in a sense. It tends to improve accuracy and make the predictions more stable, especially for models like decision trees that can be a bit unstable.
And did bagging help in their case?
It helped significantly. In their results, the bagging decision tree clearly outperformed the others.
What kind of accuracy did that bagging tree actually achieve in predicting the earnings direction?
So the paper reports the bagging tree got the highest classification accuracy at 61.87%.
Okay, 61.87%. How did the others do?
The basic tree was only just better than 50/50 at 54%, and the boosting tree got 59.16%.
So bagging really gave them a meaningful lift in performance.
It did. And another key finding wasn't just the final accuracy, but also the efficiency. The bagging model apparently reached its best accuracy much faster in fewer iterations than the boosting model did. And the paper tries to put this 61.87% figure into context. Predicting anything related to stock returns is famously hard, right?
Definitely.
Especially in dynamic emerging markets like China, where this study was done. They note that their accuracy, using just 50 indicators, actually compares pretty favorably to similar studies done in the U.S. market. Those U.S. studies often used more indicators to get accuracies typically around the 60% mark.
Okay, so the takeaway here for you, the listener, seems pretty clear. Even in a really noisy, complex area like financial forecasting, these techniques, specifically decision trees, but enhanced with methods like bagging, they can provide a concrete, data-driven edge. They can get predictions for key things like future earnings changes that are measurably better than just random chance.
Absolutely. But getting results like that, even that 61.87% accuracy in a tough domain, it all relies on having solid mathematical foundations underneath. And the sources spent a good chunk of time on some of those crucial mathematical tools.
Okay, what's one of the really fundamental ones they highlight?
Regression. Yeah, at its heart, regression is really about approximation. It's an incredibly powerful tool for finding a function, like a line or a curve, that best fits a set of data points you have.
And that's used a lot in finance.
Oh, constantly. For example, estimating complex relationships like yield curves, or for pricing financial derivatives, regression pops up everywhere.
The sources show some examples using polynomial regression, right? Fitting curves.
Yes, they use some simple visual illustrations to get the concept across. You can see how fitting a higher degree polynomial allows the line to curve and follow the data points more closely than just a straight line. And a really crucial point they demonstrate is that this still works effectively even when the data is noisy.
Noisy meaning it has random fluctuations.
Exactly. Random errors or fluctuations around the underlying trend. The regression line tends to sort of average out that noise, giving you the main relationship. It also works whether your data points are sorted or not, and you can extend the whole idea to problems where you have multiple input variables, not just one.
So the big takeaway from that regression section is really its versatility as an approximation tool.
I think so, yeah. Least squares regression is just a really robust method for approximating functions from data. Doesn't matter if the data is clean or noisy, structured or unstructured, one input or many. The sources also briefly mention related ideas like interpolation.
What's that?
Interpolation is typically used when you want to estimate values between the data points you already have. Unlike regression, which finds a best fit, interpolation often aims to have the curve pass exactly through your known points. Think like connecting the dots smoothly. Okay, and another vital mathematical tool they cover is optimization.
Optimization. Finding the best possible outcome.
Exactly. It's all about finding the best possible solution or outcome, but usually under specific conditions or limitations you have to obey, like finding the absolute lowest point in some complex landscape of possibilities, or finding the highest peak. Minimization or maximization.
Where does optimization show up in finance? That seems like it would be everywhere.
It is. Portfolio optimization is the classic example the sources use. Imagine you have a fixed amount of money to invest, right?
Yeah.
And you have a list of potential assets, stocks, bonds, whatever, each with its own expected return and its own level of risk.
Okay.
Optimization helps you figure out the ideal mix, the ideal allocation of your money across those assets to achieve a specific goal. Like maybe you want the highest possible return you can get for a certain level of risk you're willing to tolerate.
Or maybe the lowest risk for a target return.
Exactly. Or minimizing risk while still aiming for at least some minimum return. The sources show how you can use optimization software tools to find these optimal allocations. And you can factor in constraints like your total investment has to equal your budget, or maybe rules like you're not allowed to short sell an asset.
Right. Makes sense. So beyond the pure math, Understanding the statistical characteristics of your data seems absolutely critical too. The sources highlight some key statistical concepts there.
Oh, definitely. And one that's really foundational, especially in finance theory, is the normal distribution, the bell curve.
The bell curve, right?
Yeah.
Why is that so important in finance?
Well, so many core financial theories, how to build a diversified portfolio using modern portfolio theory, the capital asset pricing model, CAPM, even famous option pricing models like Black-Scholes. They often make simplifying assumptions that asset returns, like daily stock price changes, actually follow this nice, predictable, normal distribution.
Okay, but is that assumption actually true? How do the sources suggest checking if your data fits that bell curve?
They show a couple of main ways. Visually, you can look at histograms of your data to see if they roughly form that bell shape. But more importantly, they emphasize using something called QQ plots, quantile plots.
QQ plots, how do those work?
Basically, if your data really is normally distributed, the points on a QQ plot should line up neatly along a straight diagonal line. Any deviation from that straight line suggests your data isn't perfectly normal.
And what did the sources find when they actually looked at real financial data using these tools? Does it line up?
Well, this is where it gets really interesting, and it's a critical insight for anyone dealing with finance. There's often a stark contrast. Simulated data generated from certain simple mathematical models can look very normal. It might form a nice bell curve, a nice straight line on the QQ plot.
But real markets?
Real market data, like the daily returns of major stock indices, the S&P 500, the DAX, or even individual stocks like Yahoo or Microsoft that they looked at, it tells a different story.
You see those QQ plots in the sources where the points really curve away from that straight line, especially out at the ends, the tails.
Exactly. That visual pattern confirms a fundamental property of real financial markets that the sources highlight. They often exhibit fat tails.
Fat tails meaning?
Meaning extreme events, big positive returns and big negative returns, like market crashes or huge surges, happen much more often in reality than a standard normal distribution would predict. The tails of the distribution are fatter than the normal bell curve's tails.
And the formal tests confirm this?
Yes, the formal statistical normality tests mentioned in the sources, when applied to this real market data, strongly reject the idea that it's normally distributed. The p-values are essentially zero.
Wow. So that deviation from normality is a really big deal for finance models that assume it.
It's a fundamental challenge, absolutely.
Yeah.
And a key takeaway from the statistical part, another powerful statistical concept they introduce is principal component analysis, or PCA.
PCA. What's the big idea there?
What's fascinating here is it's a brilliant technique for basically simplifying complex data sets, for reducing dimensionality is the technical term.
Reducing dimensionality, making things simpler. How?
Okay, the core idea is this. Imagine you have a whole set of variables that are related to each other, they're correlated, like maybe the daily price movements of all 30 different stocks that make up a stock index, like the German DAX they use as an example. These stock movements aren't independent, right? If the whole market moves, most tend to move together to some extent.
Sure.
PCA takes this set of correlated variables and mathematically transforms them into a new, smaller set of uncorrelated variables. These new variables are called principal components, and they're constructed in a special way. The first principal component captures the largest possible amount of the total variation or movement in the original data. The second component captures the next largest amount of variation, but with the condition that it must be completely uncorrelated, completely independent of the first component, and so on.
So instead of tracking, say, 30 individual stocks that are all moving in related ways, you get maybe a few core components that capture most of the important overall movement.
Precisely. The DAX index example in the sources shows this really clearly. They found that the very first principal component, which you can kind of think of as representing the broad overall market movement, explain about 63% of the total variation among all 30 individual stock movements.
Wow, just the first one?
Yeah. And the first 5 principal components together explain something like 95% of the total variation.
That's incredible compression. You could potentially go from needing to analyze 30 different variables down to just 5 while keeping almost all the relevant information about how the index's stocks move together.
Exactly. That's a major insight for dealing with complex, high-dimensional data. PCA can really help simplify things.
Okay, let's maybe touch on one more concept, something a bit more advanced but seems increasingly influential that's mentioned in the sources, Bayesian statistics, and specifically how it applies in Bayesian regression.
All right, Bayesian methods are definitely gaining traction. The fundamental Bayesian idea, put simply, is really rooted in how we, as humans, learn and update our beliefs when we encounter new evidence. The source describes this as learning over time, the diachronic interpretation. You start with some initial belief about something.
A prior belief.
Exactly, a prior probability or belief. Then you observe some new data, and you use that data to update your belief.
And Bayes' formula is the math for doing that update.
Pretty much, yeah. Conceptually, it states that your updated belief, called the posterior probability, is proportional to how well the data you just saw fits your hypothesis. That's the likelihood multiplied by your initial belief, the prior probability. The sources use a really simple example about picking a ball from one of two boxes, one with mostly black balls, one with mostly white. If you pick a black ball, that observation directly changes your probability, your belief, about which box you most likely picked it from. You become more confident it was the box with mostly black balls. It's intuitive learning, formalized.
Okay, so how does that idea translate to regression models? How is Bayesian regression different?
Well, in standard classical regression, you typically end up with a single best guess estimate for your model parameters, like the slope and intercept of a line.
One number for the slope, one for the intercept.
Right. In Bayesian regression, using tools like MCMC sampling mentioned in the sources, you don't just get one number, you get a whole distribution of possible values for each parameter. This distribution explicitly represents your uncertainty about the true value of that parameter, informed by both your prior beliefs, if any, and the data you've observed.
So instead of just getting the slope, you get a range of plausible slopes, showing how confident you are.
Exactly. You get a richer picture of the uncertainty. And the sources show how this applies to finance, using an example of regressing a gold miners ETF, GDX, against the price of gold, GLD. You can see plots where they draw multiple possible regression lines based on samples from the parameter distributions, visually showing that uncertainty in the relationship derived from the data. But here's where the Bayesian approach, as highlighted in the source's real-world example, gets really powerful, especially for dynamic fields like finance.
Okay.
Standard regression generally assumes the relationship you're modeling, that slope and intercept, is fixed and constant over time.
But in markets, relationships change all the time, right?
Exactly. Things aren't static. So the sources demonstrate a more advanced Bayesian technique where the model parameters themselves are allowed to evolve over time. They're not assumed to be fixed. They might follow something like a random walk, meaning they can drift gradually as new information comes in.
So the model itself adapts. It learns that the relationship might be changing.
Precisely. It's constantly updating its estimate of the relationship based on the latest data. The sources show these really cool plots where the average estimates for the parameters, the alpha and beta in their regression example, actually change and evolve over the time period studied.
Wow.
And you can see this visually too by plotting the estimated regression lines for different points in time. The slope changes, showing how the relationship between the gold miners and gold itself wasn't constant.
That ability to model and learn changing relationships seems like a massive advantage in finance.
It's a significant advantage, yeah. Dealing with dynamic environments where things aren't stable over time is a real strength of these more advanced Bayesian methods. Oh, just a quick side note for you, the listener. For some of those visual examples, like the PCA on the DAX stocks and the Bayesian regression with GDX-GLD, the sources actually used absolute price levels instead of returns, which is what you'd normally use in finance.
Why did they do that?
They mention it was purely for illustration, just to make the plots visually easier to see and interpret. But they're careful to point out that in real-world financial analysis, you'd almost always work with return data, not raw price levels.
Got it. Okay. Wow, we have covered a tremendous amount of ground in this deep dive. Feels like a whirlwind tour. We started right at the beginning, the fundamental split between supervised learning predicting a known target and unsupervised learning finding structure. We used concrete examples, wages, stock market direction, even cancer cell data.
Then we traced the history, seeing how these ideas evolved from, early 19th century astronomy math all the way to becoming widely accessible tools today, really thanks to computing power and modern software.
We zoomed right into decision trees, saw how they make those step-by-step decisions based on attributes, and crucially how that research paper applied them using bagging to actually get that 61.87% accuracy predicting earnings changes in China. That was really concrete.
Yeah, and then we looked at the mathematical backbone, regression for approximating relationships, fitting curves even to noisy data, and optimization for finding those best solutions, like building an optimal investment portfolio, both absolutely vital in finance.
And the statistical side, too. Understanding the properties of data. That whole discussion about the normal distribution, how it's assumed in finance theory, but how real market data often has those fat tails, meaning extreme events are more common. That's huge.
Definitely. And principal component analysis, PCA, as that powerful way to simplify complex correlated data, like boiling down 30 stock movements to maybe 5 key components while keeping most of the information.
And finally, we dipped our toes into Bayesian methods, seeing how they let us model uncertainty explicitly with distributions, and maybe most excitingly, how they allow models to learn and adapt over time as relationships in the data change. Super relevant for finance.
Absolutely.
So the big picture from all these sources seems pretty clear, doesn't it? These tools of statistical learning, machine learning, they were once pretty specialized, maybe academic, but now they're becoming fundamental for anyone trying to extract meaning, find patterns, make predictions from the data that surrounds us.
They're just increasingly accessible and applicable across almost every field imaginable.
So as you think about everything we've talked through today, maybe here's a final thought for you, the listener, to take away. How might understanding these core concepts, supervised versus unsupervised, decision trees, regression, optimization, normality issues, PCA, Bayesian adaptation, how might that fundamentally change the way you look at the data you encounter? Whether it's in your job, maybe your investments, or even just your personal interests. Consider how these powerful tools, they really aren't just for, rocket scientists anymore. They're becoming part of an essential toolkit for all of us trying to navigate and make more informed decisions in this incredibly data-rich world.